Imagine a hedge fund led by the brightest minds on the planet. Geniuses of finance, high-flying mathematicians, former Wall Street elites, and even 2 future Nobel Prize winners in economics. A fund so prestigious that even the biggest banks were fighting to invest in it. That fund was Long-Term Capital Management, or LTCM. Created in 1994, it quickly attracted attention with its spectacular returns. I'm talking about 40% gains per year. A true money-making machine powered by mathematical models that were deemed foolproof. But in 1998, disaster struck. Within weeks, LTCM went from absolute star to a threat to the global financial system. In 1994, a man named John Merriweather decided to launch a completely revolutionary investment fund. He wasn't unknown on Wall Street. As a former vice president at Salomon Brothers, he was considered a legend in the world of finance. He had seen glory in the 80s, but also disgrace. He was forced to leave Salomon Brothers after a scandal involving manipulation of government bonds. But he wasn't done with finance. He wanted to bounce back, stronger, smarter, and bolder than ever. His idea? To create a hedge fund that didn't rely on trader intuition, but on pure mathematics, algorithms, equations, and quantitative modeling. And to do this, he assembled a dream team. And I'm talking like seriously heavyweight. He recruited Robert Merton and Myron Scholes, 2 world-renowned economists. They developed the famous option pricing model known as Black-Scholes-Merton, which completely changed how derivatives were valued and is still used today. Their work would earn them the Nobel Prize in economics in 1997. But that's not all. Merriweather also gathered a squad of prodigies. Former colleagues from Salomon Brothers, university professors, physics PhDs, systems engineers, top-level mathematicians, basically a real dream team. Actually, the LTCM team was clearly the Avengers of Wall Street. The project quickly became legendary in the industry. The biggest banks didn't hesitate for a second. Merrill Lynch, Goldman Sachs, JP Morgan all wanted in. And within just a few weeks, LTCM had raised over $1 billion. And within just a few weeks, LTCM had raised over $1 billion without even addressing the general public. It was an ultra-select fund. At the core of their strategy was something called quantitative arbitrage. It consisted of spotting market inefficiencies, like price differences between 2 similar assets, betting that those gaps would shrink, and cashing in once the anomaly corrected. With this model, they thought that they could eliminate all randomness. After all, markets are supposed to be rational in the long run, right? Well, it was on this theory and on their absolute faith in mathematics that LTCM launched. But in real life, markets have a nasty habit of not following the script. The first few years of LTCM were simply spectacular. The fund posted incredible returns. 21% the first year, then again the second year, and then 41% the year after. For investors, it was performance beyond belief. At a time when markets were already booming, LTCM seemed to be operating in a whole other dimension. But for the fund's team, it wasn't magic at all, just science applied to finance. Their statistical and mathematical models worked brilliantly. Every market anomaly became an opportunity, and the price gap always ended up correcting, and then profits flowed in. To them, this proved that their view of the market and of the world was correct. And to amplify these results, LTCM used a deadly tool: leverage. In simple terms, they borrowed gigantic amounts of money to bet far more than their own capital. With $4 billion in equity, they took positions worth up to $100 billion. That's a leverage ratio of 25, and sometimes it was even higher than that. Sure, leverage could multiply gains spectacularly, but it could also destroy the fund in case of sudden losses. It was clearly a dangerous game, but LTCM was convinced that it was controlling risk. And the banks? Well, they followed blindly. Why worry? After all, the fund was run by geniuses making money at lightning speed, and the models seemed sure and certain. At that moment, LTCM was at the top of the global financial world. The fund even believed that it was proving that on Wall Street, the smartest people earn the most money. But that feeling of invincibility would prove something very different. Thanks to their ultra-advanced mathematical models, LTCM identified micro-anomalies across global markets. They took massive positions, borrowing tens of billions to exploit price differences of just a few cents. They also bet on volatility, interest rates, foreign bonds, and complex derivatives. And over time, LTCM moved further out of its comfort zone. It began speculating on emerging markets like Russia or Latin America, highly volatile, politically risky, and often unpredictable regions. But they bet on Russian debt as if it were as safe as US debt. Then, in August 1998, an unexpected event hit the market like lightning. Russia defaulted on its sovereign debt. Yes, an entire country officially announced that it could no longer repay its bonds. It was a huge shock, and immediately all markets went into panic. Investors sold anything deemed risky and rushed into safe assets like US Treasury bonds. The problem? LTCM was heavily exposed to Russian debt. They had bet that the gap between Russian bonds and US bonds would shrink. Instead, the gap exploded. In just days, their positions collapsed. Their model, designed for so-called normal markets, no longer could make sense. Volatility was out of control, and this was just the beginning. Losses reached hundreds of millions of dollars per day, and within weeks, LTCM had lost more than 50% of its value. A big problem for them was that their positions were so enormous that they became illiquid. Basically, LTCM was trapped, paralyzed by its own model. But worse was the domino effect. No one knew exactly what LTCM was exposed to. Everyone just knew that they had massive positions across nearly everything in the market. And everyone thought, if the fund starts selling everything, it could trigger a global panic. The banks really started freaking out. Some refused to open new positions for LTCM, while others clearly demanded repayment. But LTCM had no liquidity. They were just stuck holding mountains of what was now toxic assets. At this point, the fund was on the edge of the abyss. And the problem? If it fell, it could drag everyone down with it, like a systematic collapse. It was then that the US Federal Reserve decided to do something it had never done before. Faced with the risk of contagion, the Fed rang the alarm bell. It clearly understood that if LTCM fell, it wouldn't be just one hedge fund. It could be the entire financial system, collapsing like a house of cards. Plus, all the major banks were exposed. So, the Fed organized an emergency closed-door meeting in New York at the Federal Reserve Bank. Around the table were 14 major banks: Goldman Sachs, Merrill Lynch, Morgan Stanley, UBS, Deutsche Bank, Credit Suisse, etc. The goal was simple: prevent a systemic crisis. But to do that, the Fed did not want to use taxpayer money. It imposed a coordinated private bailout. After long negotiations, a deal was finally reached. 3.6 billion would be injected into LTCM. The banks became shareholders, the fund was placed under control, and the positions were slowly liquidated to avoid triggering a panic. Funny anecdote: Warren Buffett tried a last-minute deal to buy LTCM at a bargain price. His offer? 250 million with harsh conditions. Too late and too aggressive, his offer was rejected. But the bailout plan worked. Confidence returned, and the market eventually stabilized. The crisis was narrowly avoided. However, the message was clear. One single player could shake the entire global economy. After its 1998 bailout, LTCM didn't disappear immediately. The fund continued operating and even returned a 10% gain on the next year. But in people's mind, the damage was done. And in 2000, LTCM was fully liquidated and the banks who participated in the bailout were repaid. As for John Meriwether, LTCM's founder, he tried to start another fund called JWM Partners with former LTCM colleagues. Despite promises of caution, reduced leverage, The fund lost 44% during the 2008 crisis and shut down in 2009. Again, in 2010, this time, he launched a third fund called JM Advisors Management, once again using the same strategy, but this time with very limited results. Now, I know what you must be all wondering. Why did LTCM's model fail so badly? According to historian Niall Ferguson, one major mistake was using too short a backtest period when building the models. Only 5 years of historical price data. As a result, the model didn't include major crises like the crash of 1997 or the crash of 1991 or other events that would completely change the predictions. In other words, LTCM's models were blind to extreme events because they hadn't included one in their backtests. They worked well on normal period like the model had been trained to in its 5-year backtest period, but couldn't predict or know how to react in times of violent crashes or crisis. In short, the losses of August 1998 were statistically impossible according to the model, but they were very real in practice. Personally, I find it very ironic that a hedge fund managing positions of up to $100 billion used a model that was only backtested on 5 years of data. In conclusion, I would say that LTCM's story isn't just a fund that collapsed. It's a universal lesson on the limits of intelligence in the financial markets. 2 Nobel Prize winners, returns that no one would even dare to dream of, ultra-advanced mathematical models, but not properly backtested. And in just a few weeks, it all collapsed. Why? Because of overconfidence, blindness to real risk, and uncontrollable leverage. LTCM proved something essential. No strategy, no matter how advanced, can be considered solid if it hasn't been properly backtested. Without the Fed's intervention, the whole system might have crashed 10 years before the subprime crisis. With LTCM, the world discovered a terrifying concept: too big to fail. If you've watched this far, comment backtest below. Also, feel free to subscribe to the channel or give us a thumbs up, that would really help us. As for me, I'll see you in the next one. Bye.